Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 12, the Group B exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. So we are working on 25 here. And it says common size income statement. Prepare a comparative common size income statement for Horton using the data from E12 25B. All right. So let me go back up here. All right, there's 22B. Let me just copy this and paste it here. All right, so, and it says here round to the nearest 1/10 of a percent. Okay. So, let's see here. Okay, so prepare a comparative common size income statement for Horton. Right? If you don't know what common size is, all right, go back into the textbook and read the definition of it. Okay. So I'm going to use the same information here. I'm not going to rewrite it all, but I have to create a 2014 and a 2013 column, right? And our basis for this here, for these are all going to be in percentages now, right? Because we're doing a comparative analysis here. And our basis is going to be the revenues, so that's 100% for the revenues. So if I take the 227,000 and I divide it by the 505, I get 45%. Now we're rounding to the nearest 1/10 of a percent, right? So for 2013, all we're doing is we're using 505 as the base, and then we're going to take each and every number here and divide it by the 505. So for my cost of goods sold, I have 227,000, and I'm dividing it by 505,000, and that gives me 45.0%. Okay. Then I take the 110,000 and I divide it by the 505,000, and I get 21.8%. And so that's all I'm doing is just going right down the line. 41,000 divided by 505 is 8.1%. 35 divided by 505 is 6.9%. If I add all of those up, that should be 81.8%, or I could do the math and say, okay, my total expenses are 413,000 divided by 505, and I should still come out with the 81.8%. Right? And then, of course, when you subtract 81.8 from 100%, that should be 18.2%, right, for my net income. Or, as a double check, I could take the 92,000 and divide it by 505 and get 18.2%. Okay, so yeah, that's for 2013, and then all we're going to do is we're just going to do the same thing for 2014. We're going to use the base number 595. So 270,000 divided by 595 is, for our cost of goods sold, is 45.4%. Right? 120,000 divided by 595 is 20.2%. 48,000 divided by 595 is 8.1. 30,000 divided by 595 is 5.0. Okay. If I take my total expenses of 468 and divide it by 595, I'll come out with 78.7%. And as a double check, if I add all of these numbers up, it should come out to the 78.7%. Okay. And then, of course, 127,000 divided by 595 is 21.3%. And the double check is, revenues less expenses, so 100% minus 78.7, right, gives me the 21.3, right? So the question, right, so that's it for 25, exercise 12-25. Go ahead and pause the video, rewind it. If you didn't get, go back over it if you're not understanding something here. And of course, if you still don't get it, go back and watch the theory videos or telephone and speak with an instructor. I mean, this here is not rocket science. Okay, all we're doing here is we're just crunching numbers. Okay, the biggest decision that you had to make was what you're using for your base figure, which would be the revenues. Okay, but any other than that, it's just doing math. Okay. All right, so on to the next exercise. Okay, here we go. All right, so ratios. The financial statements of Oxford included the following items. Compute the following ratios for the current year. We're going to, let's see here, net income. Round all calculations to 2 decimal places. Days to full days, percentages to the nearest tenth of a percent. Assume all sales on credit. Okay. All right, so what I'm going to do here is I'm going to work through each one of these. I'll pause the video so that you can write it down, and then I will, I'll tell you pause the video and write it down, and then I'll erase it to do the next calculation. So it says compute the following ratios for the current year. All right, so we're going to, for A, we're going to do the current ratio. Okay, so what is the current ratio? Go ahead and look in the textbook to see what the formula is. Okay. By now you should know that the current ratio is current assets over current liabilities. So excuse me, so that's what you're kind of like looking for, or you have to figure out. Okay, not all of your information is necessarily being given to you on the table. All right, so if my current assets are 195,000 and I'm dividing it by my current liabilities of 118,000, that gives me 1.65 for my current ratio. Okay, so pause the video. I'm going to erase. Okay. Next is the quick ratio. Remember, the quick ratio is a subset of the current ratio. Okay. If you just go and you say, if you, and that's what a lot of students do, they take the quick ratio and they just take current assets less current liabilities. You need to remember that the current ratio being current assets, but the quick ratio, the thinking behind it, or the way I remember it is what can be most easily converted to cash. We have our cash, which is in this case here 28,000, and we add to it our short-term investments, marketable securities of 22,000, okay, and our accounts receivable of 64,000. Okay. All right. Inventory is not easily converted to cash. Okay, so that's why the line kind of like gets drawn there. Remember, the current ratio will include inventory and prepaid expenses because that's part of your current assets, but your quick is only what's easily convert it into cash, which draws that line right there under accounts receivable. Now you have to be careful because this here. I mean, if you're going to copy exactly out of the book without thinking about concepts, obviously going into the future, you're going to make a mistake because there are other accounts that can be quickly converted into cash and would be part of the quick ratio. Okay, but for the most part, like I said, then you can't give every possible scenario that ever exists. And for the most part, from a teaching perspective, they draw the line right there at inventory and above. And this also, and it just popped into my head, this is also why we create our balance sheet in the order of liquidity, meaning how quick, how liquid, how we can change the assets into cash. Cash is the most liquid because it's already cash, so that's why it's the first thing, right? But when you go down after like prepaid expenses, then you'd have your automobiles, your building, your land, they're less liquid. Okay, it takes a lot longer to be able to convert those into cash. And so we create our financial statements in the order of liquidity, and by creating it in the order of liquidity, it allows us to more easily sort of go and say, okay, if I know this is if I'm looking at the financial statement, I'm seeing inventory, anything above it is my quick rate, is being used for my quick ratio, and I can just pull those numbers. All right, so that's just a quick aside. All right, so yeah, now we take that and we have to divide that by our current liabilities of 118,000. So when I add 28, 20, and 64, right, so that's like 84 and 28 is 112, so 112,000, okay, divided by 118,000 is equal to 0.95. So that's my quick ratio. Okay, pause the video. Yeah. If you didn't get that, go back to your Math for Business and Finance, go back to the earlier chapters. Like this here is all repetitive stuff. You've already had all of this stuff before. This is not something that needs an in-depth study because it's not anything new. Right, so my cash conversion cycle. Right, your cash conversion cycle, remember, is, and I'm going to just quickly abbreviate, days sale and inventory, right, plus my receivable collection period minus my accounts payable payment period, right? That is my cash conversion cycle. Cash conversion cycle is equal to. So what I have here is I actually have to figure out each one of these. We actually had, I forget which one. Let me just take a quick look here. Let's see. Return on equity. I'm looking at let's see. We had an exercise, a short exercise. I can't find it, so I'm not going to worry about it. All right. Anyway, so my cash conversion cycle is my days sales and inventory plus my receivable collection period less my accounts payable payment period. Right? So now what I need to do is I need to come up with three figures and do the math for all three figures to come up with my cash conversion cycle. So for my days sales and inventory, okay, I have the form. What is the formula for that? Look it up in the book. All right, it is your average inventory. Is your average inventory over your cost of goods sold divided by 365, right? So what's your average inventory? Right, so if I have inventory and the previous year was 55,000 and this year it's 77,000, well, that's 55 becomes my beginning inventory plus my ending inventory of 77,000, and I divide that by 2. Right? So when I do the math on that, I get 77 plus 55 is 132,000, and I divide that by 2, and that gives me 66. Right? So my average inventory is 66,000. And then I'm going to divide that by my cost of goods sold, which, here it is, 293,000. 293,000 divided by 365, right? So if I take 293,000 divided by 365 gives me 802.74, right? So I'm going to divide 66,000 divided by 802.74, right? That's where I'm going here. And that's going to give me, round it, 82 days. So my day sales in inventory is 82 days. Right? So pause the video and write all of that down, because I'm going to erase it so I could do the next part of this formula. Right? So here we have my receivable collection period. And the formula for my receivable collection period, again, I'm looking in the book, okay? I don't remember this stuff, all right? If I need to know what the formula is, I can look it up, but I understand how to work the formula itself. So I have my average net accounts receivable, and that's divided by my net credit sales over 365. Okay, so we're working this formula pretty much the same way. I have my net average net accounts receivable. So I had 70,000 as my end for previous year, 64,000 for the beginning of the year. So 70,000 becomes my beginning, 64,000 becomes my ending, and that's all divided by 2. So that's 134,000 divided by 2, or 67,000, right? So my average net receivable is 67,000. And then I'm going to divide that by my net credit sales of 488,000 divided by 365, right? So 488,000 divided by 365 is 1,336.98. So if I take the 67,000 and I divide it by 1,336.98, I get 50 days. Remember, we're rounding the full days. So for my receivable collection period, I have 50 days. All right, so pause the video. I'm going to erase this, write it all down. Okay, now we do our accounts payable. Which is pretty similar to the receivable collection period. It's just two sides of the same coin. Accounts receivable, accounts payable. I have my average accounts payable, and that's divided by my cost of goods sold over 365. Okay. So my average accounts payable, we have 48,054, so 48,000 was my beginning, plus 54,000 is my ending. I divide that by 2, so that's what, 90, 102, so that's 51,000. So 51,000, and I'm dividing it by, again, we're doing the same thing we just did before, 293,000 divided by 365, right? 293 divided by 365 gives me 802.73. So 51,000 divided by the 802.73, and that will give me 64 days for my accounts payable payment period. So that gives me 64 days. Okay. So now, in order, all I'm doing is I'm adding 82 days plus 50 days, and then I'm subtracting 64 days. And when I do that mathematical calculation, I end up with 68 days as my cash conversion cycle. All right. Hey, pause the video. Excuse me, as I'm going to erase it all. Yeah, go back and watch the theory videos because I do cover, like this one here is a long calculation, and I remember working through another exercise, and also it was covered in the theory video. So if you didn't get that, definitely go back. And so next is my accounts receivable turnover. Okay, so my accounts receivable turnover is my net credit sales over my average net accounts receivable. All right, so what's my net credit sales? Is 488,000, and this is over my average net accounts receivable. So I have 70 as my beginning plus 64,000 as my ending, and that's all divided by 2 because it's an average. So that's 134,000, and I divide that by 2, which gives me 67,000. So 488,000 divided by 67,000 gives me 7.28 times I turn my receivables over. Okay. All right. So pause the video, copy that down. Okay, as I work through this, I can't help but just keep in my mind here that uh, literally this here is the third time that these here ratios are being taught to you. They were covered once in Math for Business and Finance. They were covered at the end of each chapter during financial accounting, and now in this particular chapter, this is the third time that you're doing this. It's all about understanding the concepts and then working it as a word problem. What information is directly related to solving the problem, what information has nothing to do with solving the problem, and what information has to be manipulated to solve the problem. Inventory turnover, okay, is, as an example, my cost of goods sold is over my average inventory. Okay, well, what is directly related to solving this problem? My cost of goods sold, right there, is 293,000. Okay. Does cash have anything to do with it? No, so we don't need that information. There's a lot of information here that you don't need, but you have to manipulate meaning doing some kind of mathematical calculation in order to come up with average inventory. All right. If we look at our inventory and we just take the number 77,000, well, then we're going to get that wrong because we're just looking for a number and we think everything is directly related. Okay. In this case here, it's not. It's 55,000 is my beginning plus 77,000 is my ending, and that's divided by 2. This is where the manipulation comes in, right here, where you have to do some other mathematical calculation in order to get a piece of information that you need to be able to solve the problem. So 55,000 plus 77,000 is what? 132,000. Let's see, 55 plus 77, yeah, 132,000. Divided by 2 is 66, right? So I have 293,000 divided by 66,000, and that gives me 4.44 times I'm turning it over. Okay, so again, a lot of students, they just look for a number and they just take numbers instead of understanding the concept. And understanding the concept, you know that average means beginning plus ending divided by 2, right? And therefore you have to do some kind of mathematical calculation, some manipulation in order to be able to arrive at the right answer. Sure, students most oftentimes will get the 293,000 right. That's not a problem. And they know they're not using cash. But when they come to looking when it comes to inventory, they're going to look at the inventory, but they don't take into consideration that as an average. And they'll either take the 77,000 number and use that directly, or they'll take the 55,000 and use that directly. And then they get the problem wrong because they don't understand the underlying concept. Right, so enough of beating that dead horse. Pause the video as I'm going to erase this. And this video is getting to be really long here. So I only have 2 more to go here. So that was inventory turnover. So gross profit percentage. Gross profit percentage is my gross profit over my net sales. Simple enough. Right, so what is my gross profit? Right. Well, think about gross profit. Gross profit is, you have your net sales over your cost of goods sold gives you your gross profit, right? That's not the same as net income, right? These two are not the same, right? If you just quickly went down here and said, oh, my gross profit, I know it has to do with net sales and cost. Oh, so here's 61,000. That's the number I'm going to use. You're wrong, okay? Because that's not what gross profit is. You understand the underlying concepts. Revenue less expenses gives you a profit or loss. In my revenue section, I have my revenues less my cost of goods sold gives me a gross profit from which I take my expenses to get my profit or loss. Okay, that's the structure of the income statement. You have to think through the entire structure and utilize what is important. Utilize what is pertinent to that to the calculation of what you need. Okay, you don't just look and say 61,000. So my gross profit here is 488,000 minus 293,000, and then that's all going to be divided by my net sales of 488,000. So 488 minus 293 is 195,000. So my 195,000 is my gross profit divided by my net sales of 488,000. That gives me a 39.3%. Right? So pause the video. I'm going to erase this. Okay. And lastly here we have the net income percentage. So my net income percentage is my net income over my net sales. Okay. Now in this case here, relatively simple. Yeah, we're being given our net income of 61,000. So that's, a direct piece of information. And my net sales is 488,000. And that's a direct piece of information. So I divide one by the other and I get 12.5%. Okay. And that's the solution for my net income percentage, right? So I hope in going through this, I didn't spend a lot of time in the theory because we've already covered all of the theory before. But I hope I've somewhat impressed upon you the fact that, If you understand the formula, right, whatever you're looking for, that particular ratio, okay, if you understand it, then it's a matter of deciphering the data that you need in order to be able to solve for that ratio. And this is nothing more than a word problem that you've worked through in Math for Business and Finance, math applications, and in previous chapters. You have information that's directly related to solving the problem. You have information that has nothing to do with solving the problem. And then you have information that has to be manipulated, right? And manipulate it means a mathematical calculation. And that's all determined by the formula itself. Like, as a comparison, the gross profit percentage was the gross profit over net sales, okay? Versus the net income percentage. Here with the net income percentage, you have two pieces of information that are directly related. But over here for the gross profit, you only have one piece of information that was directly related. Here for the gross profit, we actually have to do some kind of mathematical calculation in order to come up with that piece of information to solve the problem. All right, and a lot of students don't do that. They're just looking for the quick and easy, and they're just picking numbers. Okay, so with that said, I'm done with this exercise, and if you didn't understand something, go back and watch the theory videos. I know it sounds like I'm harping, but it just drives me nuts at this point in time that students can't get this right, but that's just a personal thing. All right, so if you just still don't understand something, feel free to call and speak with an instructor so that we can put you on the right track, and I'll see you in the next video.